Capital, and I'm a trading services manager with Charles Schwab out here in California. With me today, as usual, on Tuesdays is my friend, trading colleague, and chartered financial analyst, Skylar Marin in Texas today. Where are you today?
I am in Texas, and thanks for having me on, Lee.
Sure. Couple of logistical items before we get going. We want to hear from you, so send in your questions in the Q&A functionality underneath the presentation window. Your questions are private, will only be seen by Skylar and myself. We'll try to make it as interactive as possible. We can't always get to all of them due to the number of people on these sessions. We also have our usual written disclosures we are required to show. Everything we talk about should be considered as educational and informational in nature only, not to be construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts. We do not recommend the use of technical analysis as your sole method of investment research. We evaluate markets and industries and sectors with ETFs, but if you're going to actually trade those, read a prospectus. And also, we tend to look at futures contracts. If you're going to trade those, read the risk disclosure statement for futures and options. Okay, with that, let's put up the heat map and we shall review the news. All right, starting overseas. The Bank of Japan left its key policy rate unchanged at negative 0.1%, but yet more stimulus. They upped the size of their special lending program by 25 trillion yen, from 75 trillion to 100 trillion. So they are joining the central bank stimulus program, right, Skylar?
Unlimited caps, it seems like.
Yeah. It does seem that way. The other major news overseas was the ZEW expectations index. If you're not familiar with ZEW, they ask 300 experts every month from banks, insurance companies, and financial departments of selected corporations about their 6-month forecast for the economy, inflation rate, stock markets, etc. So anyway, the data today showed that French, Japanese, and Italian economic expectations from analysts are the highest since 2004, with German expectations the highest since 2006. In general, the analysts polled by ZEW saw a large bounce in activity and small marginal improvement in actual economic data. So they are a little bit more optimistic than the data, at least now, would say. But this is a typical pattern if you look at the data historically, which you get during economic downturns. But it does go to show how important expectations and confidence are as opposed to just what's happening now. Based on that, the European indices closed noticeably higher. Germany was up 3.3%. The FTSE gained 3%. France's CAC was up 2.8%, and the European stock 600 rather advanced 2.9%. Also, from overseas, good news in the virus front. The BBC reported that a study done by Oxford University shows that basically one of the old line steroid drugs has been very successful in cutting the death rate of people on ventilators. The drug is dexamethasone, and it showed the risk of death for patients on ventilators was cut by 1/3. Scott Gottlieb, the former FDA chief, said that was a major. Plus, it's a cheap drug. I mean, it's been around forever. You ever watch Everest movies? When they get altitude sickness, sometimes they give you a shot of dexamethasone. And yep. Anyway, moving to domestics, the big news was a big surge in retail sales. It surged 17.7%, handily beating the consensus of 9%. Yeah, but look what you are comparing it to. You know, you're comparing to April. So yes, it jumped, but you would hope it would jump. So I think the key takeaway here is that it does reflect some pent-up demand. And as I said, the April base that you're comparing it to was really bad. But if you look at year over year, retail sales are still down 6% year over year. But the market, of course, is going on short-term sequential comparisons as opposed to absolute numbers.
Yeah. I'd say the 6% down is, I mean, you figure the GDP forecasting from the Fed is about a 6% drawdown for 2020. So you figure if that's all it is versus the kind of the expectation of the trend, even in absolute terms, it doesn't seem as bad. Um, and I thought on the numbers were what was most interesting to me was that auto sales I think were higher, significantly higher than expected. And I thought that was interesting considering even though they're removing some of the lockdowns, we still have quite a bit of people still working from home. And so it's surprising that those numbers were as positive as they were, I think.
Yeah, they definitely getting a boost. Excellent. What else did we get this morning? Bloomberg reported that the Trump administration is preparing a $1 trillion infrastructure plan. Of course, we've had infrastructure weeks, since the beginning of the administration, and nothing ever
Right.
happens. But anyway, the headline is resonating with the markets, even if the plan never comes into fruition yet again.
Yep.
Yeah.
It
We
does.
also had, yeah, go ahead.
I was just going to say on that one, there's at least some optimism, I think, built around the idea that President Trump has the 1 million projection, Democrats have a different number, but at least there's even if I don't know about the immediacy of how soon it'll pass, but it is one of those things that at least there's some common agreement that certain things do need to be done. And hopefully at some point in the next year, and markets are looking forward a year, that perhaps we'll get some traction there. Perhaps.
Yeah, hopefully. I mean, a lot of things are crumbling, so it'd be nice.
Yeah. Bridges.
Yeah, exactly. What else did we get today? We got the industrial production. It increased to 1.4%, a little less than the consensus was looking for, 3%. The key takeaway here is that, as you were saying, the big uptick was in the output of motor vehicles and parts, just like you said. And then, of course, we had builder sentiment jumped 21 points in June to 58. That's the largest monthly increase ever in the National Association of Home Builders Housing Market Index. In this series, anything above 50 represents a positive market. Remember, in April, it fell down a record 42 points in 1 month to 30, but it just come roaring back. And also, Lennar had really good earnings today as well. Current sales jumped 21 points to 63. Sales expectations rose 22 points, and buyer traffic more than doubled from May to June. So we've pointed out, haven't we, Scour, the home builders, they've been on a tear.
Right.
And the final thing is that let's talk about, we had that turnaround yesterday based on the Fed announcement that they were going to buy corporate bonds directly. And you were talking about this earlier. This is a little bit strange to me because they always said they were going to do that. All they really did was say that, okay, now we have the facility set up to do it. Because they said on March 23rd that they were going to purchase corporate bonds through 2 facilities, the primary market corporate credit facility and the secondary market corporate facility.
Yeah.
So they've already done the primary. That's where they buy bonds directly from the companies. And the secondary market one was designed to involve both purchases of bond ETFs, which they have been doing, and also regular bonds in the secondary market. So all they did was say, okay, we're ready to do it, but they've already said they were going to do it. So I think this was a little bit misinterpreted. It took a little while to set this up, and they are going through BlackRock to do so.
Yeah.
So anyway, but the market took it as positive anyway.
I guess it's all they need to do is just keep announcing or iterating things that they're already doing, and the markets will be at all-time highs shortly. So that'll be nice.
Yeah. Yeah. All right. So we have a question already on this heat map. You just get it from going to research on Schwab.com, futures. Let's do it again. And then the heat map button. As long as they're talking about heat maps, once again, I'll just show you this other thing that people like. Go to trade markets.
Mm-hmm.
And if you want heat maps on what's moving the major indices, they are all down here. Okay, so you see that, see what's going on, the infrastructure thing, you know, Caterpillar's moving today. You can do it by indices. You can do it by particular sector in a particular index, and you can do it across different time frames. So there's, if you like heat maps, there are lots of them available. All right. Let's start with our commodities review. If I missed anything, you just let me know, Skylar.
Sure thing.
We said that gold is range bound. It continues to be range bound. So if you want to trade the trend is sideways. You buy near the bottom of the range and sell near the top of the range. Right now, the risk to reward isn't that great because you're right in the middle of the range.
You
But
could, as I say, you could play it with the assumption that the what is it, the 50 or the 20 act as support and put a stop below that. But you can see it's broken through that a couple times. So I'm not sure how
yeah.
strong those are.
Yeah, and also they're relatively flat, so you can kind of trade through them.
Mm.
I do more horizontal support and resistance here, I think.
Okay.
Yeah, let's take a look at the copper. Somebody wants to see the doctor here. A little bit of a pullback, but holding the 200-day moving average. It turned around today. It was down earlier. I think it's more profit taking. I can't say that just given the overall trend that it is really giving a divergence signal to the market. It's already run up, I think, in anticipation, but it is not going down. It is just making a higher low right now.
Right.
So we had a question on Trader Talk that I think it was kind of a negative divergence a little bit the last. Not really. I think that it's fine. I mean, it's confirming what's going on. You take a different view. I think if it, you know, went back down through the 20 maybe in the short term, but I don't think that's going to happen.
As a kind of more of a market technician, do you think does the you had the kind of the ascending triangle, that top line, if you extend it out, does that count, or does it no longer kind of become relevant once it breaks out of the trading range?
No, well, usually in a, you know, if you want to consider it a channel, usually when you break out of a channel, you often go back and test the breakout level. So I think that's what went on today.
Okay.
You can see we went down to it and we popped right up about it. So I cannot say it's bad action at the moment on this. All right, let's take a look at oil. Speaking about tests of a breakout level, oil did the same thing here.
Hard to disagree with some of the consolidation or retracements that we've had, I think, on both commodities, but also on the broader indices. There's been some good retracements and then bounces off those lows. So we'll see.
Yeah. So anyway, I think the key level here, at least on West Texas Intermediate, is 35-ish. Looks like pretty good support. And we kind of, you know, maybe we'll go up and totally fill the gap this time.
Yeah.
But it is an improving chart, I'd have to say that. And we'll take a look at the XLE when we do the sectors, but and oil services have been on kind of a tear too. Okay, I have a question on what is your view on a commodity ETF to play the dollar devaluating increased inflation? Well, if you want just a broad base, most people use the DBC. it also pulled back and held.
Hmm.
You can see what this is, a lot of different commodities at once. We see what's in here. So you got crude oil, you got Brent, you got gasoline, you got copper. You get pretty much all of them. So, and to your point, Ronald, we have pointed out before that we are kind of at a weird ratio between the stock market and the commodity market. I'll show you that chart too.
Okay.
I mean, we are well out of whack where the market's gone up a lot faster than the commodities market. So if you get any type of mean reversion, it should help commodities. And to your point about the dollar, let's take a look at the dollar index as long as we have this up here. So we've broken, obviously we broke the main level there at 99-ish, and now, so the dollar is now at least in a shorter term downtrend, which should be good for commodities. It's also, of course, some people think that all this stimulus will cause inflation at some point, but there is no signs of inflation currently, though.
I'm,
All right, go ahead.
I'm,
Yeah.
I was going to say, I'm curious on that one just because I know Schwab put out an article about this specific subject on kind of inflation or how it might be a little different this time, knock on wood being kind of the the last thing an analyst wants to say, but that it's more about the velocity of money. So I'm curious how quickly that could change if we start to see much higher increase in the velocity of money leading to inflation. So because I know the current projections aren't that, or that we're not going to see a whole lot of inflation pick up for the next kind of 2 years, 1 to 2 years at least. But I'm wondering if that's something that could change quicker than they're anticipating. So.
Yeah, I mean that is the fear out there, and if we take a look at, I mean, the money supply is just taken off, right? So
Argument is, yeah, you have more supply, but there's not, it's not moving through the economy fast enough to actually translate to inflation.
right,
But yeah, it's absolutely picking up. Yeah, you can see what that chart looks like.
yeah, and you can see there's even it is going up at a faster rate than when they did the last QE back in the financial crisis.
Right.
So there's a lot of stimulus out there for sure. All right, let us take a look at the. We have a question: is the falling dollar also good for stocks? I've done correlation studies. It's all over the map. I will say that um, generally speaking, if you do get a falling dollar, again, for the stock market as a whole, it is all over the place, the correlation. But generally speaking, the exporters will do a little bit better. So you look for the, the falling dollar is probably better for the large cap exporters as opposed to the smaller cap stocks. I will say that there is some positive correlation there, but I think I have a chart of the dollar versus the. Let's take a look. I have that chart up.
I feel like you'll have like 5 of them, Lee.
Yeah, yeah. Or I could build one for you right here with the correlation. I don't think we have time to do that, but I would just say the correlation is all over. Sometimes they're positively correlated and sometimes they're negatively correlated. Again, the only thing that's kind of sticks in my mind is that it can be better for the exporters. The other thing, you go ahead, yeah.
I was just going to say, I would mention that although you'll have a direct impact on certain companies that have a lot more international exposure or translation exposure on their balance sheets, but it's hard to predict its actual like translation into stock performance, just because we're looking at, I mean, especially you're looking at the broad indice, because there's other factors that are going to have outsized impact on corporate earnings and on price to earnings growth multiples than necessarily just on the strictly dollar. So it's harder to isolate strict impact of the dollar versus corporate earnings. But on an individual scale, you expect to see a little bit more fluctuation depending on how large of exposure they have.
Yeah, good point. I would also say that what the lower dollar does often, though, of course, is it increases inflation a little bit at some point, right? Because
Yeah.
prices are higher if the dollar is lower on a lot of the stuff that we use. So there is that. You want to look at silver? Yeah, we can look at silver. We aim to please. It is just like it's range bound, just like gold is. So
if it had, I mean, it was almost head and shoulders ish
yeah,
from last week, but didn't break, or at least
right,
didn't
didn't
hold
break.
Yeah.
Right. So now you got this band of support. You're okay on the long side as long as you kind of hold this band of support somewhere between 17 and 17 and a quarter, somewhere in there. It's still a head and shoulders. It just hasn't triggered yet.
Yeah.
So,
Fair.
yep. So I would say it's range bound. All right, let's look at the market. All right, so we have one question before I go into what I want to talk about is what would to expect if they close this gap? I would expect a run up to test the high.
Yeah.
That high. That's what I would expect. Kind of interesting. They bought it right up on the 20-day.
Yeah.
Very interesting there. Again, in spite of what I've said, and I still feel that we're going to have choppiness for the next little while, just because of all the things we've been talking about. And another one just popped up, which has been a short-term negative. All right. So speculative traders and options. We talked about this last time before the decline last week. We talked on, I think, last Tuesday, actually. Well, there was a speculative excess of small option traders buying many more calls than puts, which historically has been kind of dangerous. Now, of course, people are saying, well, okay, that big drop of the 1,800 points wrung out that speculative aspect, but that's not really what happened. As a matter of fact, it got worse. So last week, through the end of the week, so that's after Thursday's decline and the kind of tepid rebound on Friday, speculative activity, which we define here as calls bought to open minus puts bought to open, was twice as extreme, as it was in February before the top. They spent nearly $4 billion more in premiums on calls versus premiums they paid on puts. If you want to do it in percentage terms, they spent 52% of their volume on buying call options, and this is a record high. Unfortunately, it's tied with the most extreme weeks in 2000. And I would have to say, we just look at that, but the bigger option traders are kind of going wild too. If you take a look at traders trading 50 or more contracts at a time, they also had a record or a near record on speculative calls versus puts. So if you take a look at all traders, okay, both the 10 lot traders and below and the 50 lot traders, they bought 22 million more calls to open than puts to open, and they spent $6 billion more on calls than puts. Now, some people said what the reason for this is you got new set of traders stuck at home who haven't seen stocks go up for the last couple months. And so maybe it'll give a little short-term push, but these particular sets of figures have never ended well in the short term.
Hmm.
So I'm just saying a little bit of maybe choppiness, and that's why.
I was gonna say one of the other things I'd factor in, but is just that there's been over the last, I mean, since 2000, right? Especially in the last decade, there's been an increased focus on and education around the use of options. So it wouldn't surprise me to see, I'd say, more speculation, more activity by retail investors, but also, newsletters and different things focus on it quite a bit too. I don't know whether that lends or detracts from that kind of idea, but it doesn't surprise me that there's a whole lot more activity around that.
Yeah. Now let's look at another kind of sentiment. So in another Bank of America Merrill Lynch study of 212 mutual fund, hedge fund, and pension fund managers, 78% of them think the market is overvalued. That is the highest reading on record. It is higher than we saw at the dot-com boom. Now, would this lead to a sizable correction? Well, I don't know, because here, what you have, all right, they think it's overvalued, so they're a little bit less invested. There's, they're probably underexposed, which means there's a lot of firepower out there. So
Right.
we got these conflicting things, and that's why I'm just saying it might be a little choppy here in the short term. But longer term, we've talked about this over and over. You've got all these volume thrusts, breadth thrusts. Generally speaking, those things have led to decent returns 6 to 12 months out. Anyway, now let's just look at key levels here. So we mentioned let's look at the spiders, since people we trade those. So we'd have to say they bought up that pull back to the 20 this morning.
Pretty strongly, yeah.
Yeah. So, and to the point about, probably will fill that gap in the short term.
Yeah.
Uh,
long tail to not to have a follow through on it. I mean, certainly news could drive it, but it's it looks like we'd fill the gap and retest highs at that point, right?
Yeah. We got a question: how long before the market corrects after all this? Just looking at the data, usually within a month. So, where do you find this information on call volume? You got to go to the CME website. Okay. Let's see. You have any other comments here on the general levels that you want to make, Skylar?
No, I think there was a commentary a little bit, or a question a little bit earlier, kind of referencing earnings expectations. Has there been any update on that one, or to your knowledge, or is it, or where are those levels currently?
All right. Well, yeah, we talked about this yesterday, actually.
Oh, did you?
Yeah. So the consensus estimate for 2021 right now is 163 for the S&P 500. That puts the forward PE at about 21.5, which is elevated. Doesn't mean it can't go higher, but it is elevated. The current estimates for 2020 are an S&P earnings of about 123. They don't see the real strong rebound basically until now, Q4 and Q1 and Q2 of next year.
Okay.
Yeah, that's from FactSet. Yeah.
Yeah, I mean, it's certainly statistically very very elevated, but for what it's worth, traditionally exiting a recession, markets are almost always overvalued, right? Leaving a recession. So,
Right.
because you have to wait for the earnings to catch up. So I don't know that that necessarily means that that translates immediately, but to, you know, a significant pullback or, you know, a bear market, but it just means that, yeah, certainly could expect some choppiness as we try and figure out what the right levels actually are at, especially with all the liquidity out there.
Yep. I got a question. Why do I have my candle set as changed to the open as opposed to change from the close? In other words, the red or greenness of the body. Simply because if you like to look at candlestick signals for short-term reversal signals, based on the research by Steve Nissen, who brought candlesticks to the US in the late 1980s and is considered the candlestick guru. All of the little candlestick things like hammers and abandoned babies and three birds and all those things are based on the settings from the open as opposed to the close. So if you're looking for self-fulfillment of some of the short-term patterns, you're probably better looking at it that way. That's why. Okay, let us look at the NASDAQ. Didn't even get to the 20. Let's see if it. Yeah, look at that. It reversed at the 10-day. Talk about a shallow pullback.
Yeah. Then even when it did pull back a few days ago and it hit the 20, that didn't last long.
No, and it's very interesting that that coincided with the previous high there, right?
Right.
Pulled right back there. Where is a good place to get the S&P earnings current and projected? All right, I can show you. As I said, we aim to serve, right?
And you're the one who has all these things saved and ready to go.
All right, so just do this. FactSet earnings. How to spell it right, though, I found. Insight. John Butters is the analyst. Comes out once a week on Friday, and it'll give you everything you want to know about. Or I'll make it a little bigger for you. Okay, and then to get the estimate, you got to. They'll give you the current P and everything, but they don't give you the actual numbers for the estimates and the summary. So you got to go all the way down to the bottom. Not that I do this every week. So number one, if you want to see the course of the earnings, you do the look ahead, forward estimates, and valuation here. But again, they're not giving you the actual number. Okay, they're just giving you the percentage change. If you want the actual number, okay, you got to go continue down to the bottom. It's a long report.
And in order to get to the bottom, you have to read diligently everything in between.
That's right. That's right. So. I'll also give it to you by sectors too. We keep going down here. There you go. So current estimates for this year right now are 127. And then 163, as I mentioned, is for 2021. They'll also, you can get it by quarter down here too. All right. So if you want to do the 12-month forward PE, right? You do the last four bars, 1, 2, 3, 4, and on the quarters there. I mean, wait a minute. This is per year, and then the quarters are down here.
Okay, I was like that.
Yeah, 1, 2, 3, 4. So if you want the forward 12-month current bottom-up earnings estimate, you just add those four together, and that'll give you the value, and then you've got the E. You know where the S&P is, you can get the PE.
Mm-hmm.
All right. So you won't need me anymore, though, if I show you all this stuff. All right.
You got to work on not teaching people to fish. Okay.
I know. Just got to give them the soul or whatever it is. All right. All right. Let's take a look at the Qs.
Yeah,
Same thing.
there's strength.
There's strength. Let's see if the
Sucks.
yeah. You want to take a look at the stocks? Well, let's do that in the sectors. We'll do the Russell and we'll do the stocks. Yeah.
Not as good.
No, but outperforming today a little bit. But certainly ran into resistance to 200. You can see the tail up there at the 200.
Yeah. I'd also say that, I mean, right where it's at, literally like right now, you look back to mid-March, it had some kind of, or it was previously support and then broke down once it gapped or fell below that, right?
Mm-hmm. Mm-hmm. So, see how it acts around the 200.
I
But
still think, go ahead.
Yeah. No, go ahead.
I was just going to say that I would still expect a lot more weakness in the Russell than any of the other indices. I mean, especially with the smaller players, higher debt servicing costs, and I was looking at it earlier. The credit spreads from some of the or for high yield and kind of junk markets still haven't come down in a large way in the same way that the markets have kind of rallied and renewed confidence about economic strength. And so I would, even though you'd traditionally expect to see small caps kind of lead coming out of a recession, I think there's still going to be trailing concerns over debt servicing costs and some of the lasting effects in this area. So I could see that kind of dragging.
Interesting. That's why we have a CFA on as well as me. Okay. We got a question on the VIX. Yeah, we can see the VIX. Again, what I'm looking at on the VIX, I'd feel better if it dropped below there. We talked about this several times. So the market's up kind of strong today. The VIX is also up, generally speaking. That means they are hedging a little bit of this move.
Hmm.
So, yeah, so our longer term VIX signal that we look at has certainly not switched to a sell yet, though. We went to a buy right in here. Again, this is from Tom McClellan. This is the upper Bollinger Band with a different setting. We just look for a change in the slope of the upper band. And I've got the signals from the last few years up there. It's been pretty good. So right now, in spite of today's action, still it is positive, but maybe in this is again, I mean, if they're today, if they're hedging against this 500 or 600 point move, so they're a little bit worried, perhaps more than you might think. All right, let us look at the sector action. So we have a little bit of a cyclical bent. Financials were weaker. They've come back a little bit today. Steel, let's take a look at steel, obviously for the infrastructure trade. Pull back to the 20. I don't think the 10 is really in play there. It's the 20. So somewhere in here is your support. But right now, you made a higher low, really. So the shorter term trend is up, and you might use the 20-day moving average there. Okay, let's see what else is. Real estate has come back a little bit. Testing the 200. So this is critical. You'd have to say it failed really last time up here. You didn't get, you only got 2 days above it. I'll have to see if it acts in here. As I said, one place you might want to look in the REITs, in the mortgage REITs. This is pretty nice setup, right? Pulled back to its breakout level, held at 20, and now is emerging out of the pullback, though it's off a little bit from the highs today, but
Yeah.
you're getting a okay setup there. All right, let's see what else.
Semiconductors was on
Yes.
the docket.
Yep, let's take a look at them. Actually, it's lagging a little.
Yeah.
One of the reasons is that we talked about this on Trader Talk, but Morgan Stanley downgraded NVIDIA and Intel today.
Yeah.
So that's a little bit of a headwind. But on the other hand, it's still making higher highs and higher lows. Technical analysis 101. Bump, 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 bump.
Yeah. We'll see if this next one.
Yeah, we'll see if the next one, but it's still, in spite of it lagging a little bit, and in spite of those downgrades, it's still doing okay.
Yeah.
The other one that has been, let's take a look at this is kind of interesting. Big reversal yesterday on the biotechs.
Yeah.
Held support. Looks like they're going back up again.
Long tail.
Long tails. Yeah.
It's a good consolidation in that range too. I mean, right? Like as far as the range it's been in.
Yes. So, you know, if you're not in it, I mean, maybe you look for a break above here. But to your point, it's a nice consolidation after a huge run up. We are correcting here by time and not price, which is actually better.
Hmm.
All right.
I was gonna say it's consistent with healthcare as a whole, right? It's been kind of range bound for a little while.
Yes, it has.
Yeah, there you go.
What's healthcare itself? These are medical devices. They're all about the same.
Yeah.
Although biotechs are consolidating at their highs, these are consolidating a little bit under their highs. That's the only difference. In software we want to see. So these are the S&P software stocks. They've been strong for sure. Looks like they're going to go test the high.
What's sure, right?
This
No,
one is at the high. Yeah, what, Skylar?
I was gonna say which companies are in the XSW versus the
IGV.
yeah.
All right, now we can compare it to the so this has got some of the ones that have really been moving lately, right? Zoom, DocuSign. DocuSign's getting put into the S&P 500 on June 22nd. And now we can look at the IGV and you can compare the two. So let's do that. Again, this is a teaching moment, how to do this. So I hate giving away all these secrets though. All right. All right. So totally different.
Yeah. Seems
So
like IGV has a lot more. Oh, it's because it's all the S&P. Well, they both have S&P listed.
Yeah. There's just the difference though. You can see it's totally different. So what you can do, which one has been doing better? Let's take a look. We can figure that out too. Let's compare the XSW to the IGV and see which one has been outperforming. Again, if you're a momentum trader, you'd want the one that's outperforming, right?
Mm-hmm.
So in general, except for the last couple weeks, it's generally been the XSW that's been outperforming a little bit.
Curious how much of that is Zoom at this point.
Exactly that. So, and with that, our time is up. So thank you very much, Skylar, for joining me today. Lots of good insight on that fundamental side. Thank you very
Thank you
much
for
for that.
having me.
And coming up next, introduction to options trading with Mike Ruskoff, my buddy in the Big Apple, New York City. So stay tuned.
Hello and welcome to the Quick Start video for the Watchlist tool available on Schwab's StreetSmart Edge platform. The Watchlist tool allows you to monitor a wide range of streaming market data like last trade and volume about securities of interest to you. Let's load the tool by going up to Launch Tools and then click on Watchlist. Once opened, to create a new Watchlist tab, right-click on the tab at the top of any watch list and select New Watch List, or click the plus sign next to those tabs. Simply add symbols up in the symbol box that you want to add to your new list, and be sure to name it by double-clicking the title of the tab, or right-clicking and hitting Rename X2 so that it is identifiable going forward. Do you have separate sectors or strategies